You see oil prices going crazy, the headlines are everywhere, and what's the first thing that pops into your head? Probably something like, I should buy Exxon, right? But what if you're betting on the fastest car in the race, but you're completely ignoring the guy who owns the racetrack itself? Today, we're going to look past the price of oil and dive into the infrastructure that makes the whole system run. Okay, let's just sit with this for a second, because this quote, man, this probably feels painfully familiar to a lot of us. You see a stock or a commodity just taken off. The news is buzzing, and you feel this pull to get in before you miss the whole thing. It's a powerful feeling, almost impossible to ignore. So why do we do this? What's going on in our brains? Well, it boils down to this little psychological quirk called regret aversion. We are fundamentally wired to avoid the pain of looking back and thinking, I knew I should have bought it then. It's a horrible feeling. And to avoid it, we often react to the hype, buying high when everyone's excited, and then panic selling when the sentiment turns. And that brings us to a really critical question. Chasing the price of oil is one way to play it, for sure. But what if you're playing the wrong game altogether? What if the real, more stable opportunity is hiding somewhere else in that whole energy supply chain? Let's frame this up. You can really think about this in two completely different ways. You've got the bet on price, that's the commodity, the oil itself. And then you've got the bet on the pipes, the actual infrastructure that moves it around. These are two totally separate strategies. All right, check this out. On the left, you've got the commodity. It's all about price, it's super volatile, it swings with every news headline. On the right, you have the infrastructure. This is driven by volume, how much stuff is flowing through the pipes. It's built on more stable, long-term contracts. It's less like playing in a casino and, a lot more like owning a toll booth on a highway that everyone has to use. And this really gets to the heart of the problem. When you buy a stock hoping the price of oil will go up, you're not just investing. You're basically trying to be a fortune teller. You're trying to predict geopolitical conflicts. You're trying to predict future demand. Things that, as the sources point out, are just notoriously difficult, if not impossible, to get right consistently. So let's really dig into this toll booth idea. Instead of worrying about the price of the cars or where they're even going, you just invest in the highway itself, the one thing they all have to pass through. You're investing in the essential bottleneck of the entire system. This quote from one of our sources just nails the concept perfectly. Just do me a favor, swap out the word electricity for oil or natural gas. See? It doesn't matter if oil is $50 a barrel or 150. As long as we need it, someone, somewhere has to physically move it from point A to point B. That transportation piece is non-negotiable. And look, this isn't just some abstract theory. Here's a real-world example. The Trans Mountain Pipeline expansion in Canada is literally an energy superhighway. They tripled its capacity, so now it can move almost 900,000 barrels of oil every single day. The companies that own this thing, they're collecting a fee for every one of those barrels, no matter what the price is on the news that day. So how does this toll booth actually work? How do they make money? It's a pretty brilliant three-step model. First, they lock in these long-term contracts, often called take-or-pay contracts. That means customers have to pay for the reserve space in the pipe, whether they actually use it or not. Pretty sweet deal, right? Second, they just collect fees on the volume that passes through. And third, all of this creates a revenue stream that's way more stable and predictable because it's largely insulated from the wild price swings we see in the market. Now, a lot of these companies are structured as something called a master limited partnership, or an MLP. And this part's kind of key. They trade on the stock market just like any other stock, but legally, they're partnerships. And here's the kicker. The profits get passed directly to investors without being taxed at the corporate level first. This often leads to much higher yields. I mean, right now, some of these midstream MLPs have yields that are 3 times higher than the S&P 500's dividend. That's a huge difference if you're looking for income. But, okay, let's pump the brakes for a second. It's super important to remember that no investment is a sure thing. There's no such thing as a perfect, risk-free hedge. And investing in infrastructure, even if it is more stable, it's not without its own set of risks that you absolutely need to know about. Let's just walk through them. First off, a massive glut of oil on the world market could hurt everyone, right? It might just reduce the need for transport overall. Second, yeah, you're not betting on the price, but a pipeline can still be physically disrupted by a war or a conflict. Third, as we've all seen in the news, just trying to get a new pipeline approved and built, wow, that is a huge political and regulatory fight. And finally, as one of our sources wisely points out, anytime an industry is doing really well, you better believe competition is going to show up to get a slice of that pie. So when you put all these pieces together, what you've got isn't just a different investment idea. It's a whole new lens for looking at the entire energy sector. It's a fundamental shift in perspective. And here's the final takeaway.
This isn't about saying one of these strategies is better than the other. It's about understanding what game you're choosing to play. Do you want to be a high-risk speculator trying to guess which way the price will jump? Or are you looking for a more stable, income-focused investment that's based on the physical, essential movement of energy? They're just two different tools for two very different jobs.
So I'm going to leave you with this one question to chew on. When you look at the energy market from now on, what are you going to see? Are you going to be focused only on the fuel itself, or can you now see the incredible value in owning the highway that it absolutely has to travel on?